Welcome to the Explainer. Today we are pulling back the curtain on mutual funds. We're going to go way beyond just the basic numbers to help you really understand how your investments are performing.
You've seen this a million times, right? It's practically the wallpaper of investing. But it's so much more than just legal fine print. Honestly, understanding this one sentence is the real key to becoming a smarter, more confident investor.
And that's the big question, isn't it? It's easy to look at your statement and see if the number went up or down. But how do you know if that gain was actually worth the stress of the market's ups and downs? Well, in this explainer, we're going to give you the exact tools to figure that out.
Okay, so let's start at the very beginning with the one thing everyone wants to know: returns. It's the first thing we all look for, the headline on our investment report card.
Now, the most basic way we measure this is with something called a simple return. It's just a straight-up calculation that tells you pretty clearly how much your investment has grown or shrunk.
All right, let's make this real. Imagine you decide to invest in a fund. The price you pay for one single unit, that's called the net asset value, or NAV, is, let's say, 12 rupees. That's our starting line.
Okay, so some time goes by, you let the market do its thing, and then you check back in. And hey, great news. The NAV is now up to 15 rupees a unit. So your investment is definitely worth more. But by how much exactly?
Well, the math is pretty straightforward. You do the quick calculation and boom, a 25% return. And let's be real, seeing a 25% gain feels fantastic. But is that really the whole story?
And here's where we get to the heart of it. That 25% return, it didn't just magically appear. See, every single return comes with a silent partner, risk. And learning to see that risk is what takes you from being a casual investor to a truly savvy one.
This is the question you have to start asking yourself. Was that 25% gain the result of a nice, steady strategy? Or did your fund have to take on a massive amount of risk where things could have just as easily gone completely south?
You know, risk isn't just one big, scary blob. It's actually split into two main types. On one side, you've got systematic risk. This is the big picture stuff, like an economic recession that hits everyone. You can't really dodge this. But then there's unsystematic risk. This is specific to one company or one industry, and this is the kind of risk you can manage by, not putting all your eggs in one basket.
And beyond just those two big categories, fund managers are basically navigating a minefield of other potential issues. You've got interest rate risk, where a change in rates can affect your bond values. There's liquidity risk, the danger you can't sell when you want to. And of course, credit risk, which is the simple fear that a company just won't be able to pay back its loans. It's a complex world out there.
But thankfully, you don't need a degree in finance to get your head around all this. To make it easier for everyone, SEBI created this brilliant little tool called the Riskometer. Think of it like a nutrition label, but for the risk in your mutual fund.
The Riskometer is beautifully simple. It just has a 6-level scale, running from low all the way up to very high. So with just a quick glance, you get a really good sense of the kind of risk you're signing up for. It's an amazing starting point.
Okay, so we've talked about return and we've talked about risk. Now it's time for the main event, putting them together. This is where we figure out if the reward was actually worth the ride.
So, how do you know? How do you know if you were actually paid well for the risk you took on? Well, the pros use a couple of key tools to figure this out. And believe me, they are not as intimidating as they sound.
Let's start with the big one, the Sharpe ratio. This is the classic way to measure risk-adjusted return. Basically, it answers the question, how much bang did I get for my risk buck? It looks at the return you made above what you could have gotten from a super safe investment, and then it weighs that against how volatile your fund was. It's really just a simple 3-step process. You figure out the extra return you got for taking a risk, and then you divide that by the amount of risk you took. All you need to remember is this: a higher Sharpe ratio is better. It means you're getting paid more for every unit of risk you take. Then there's another cool metric called alpha. Now, alpha answers a totally different question. Did your fund manager actually earn their keep? Did their skill add value? Or did the fund just go up because the whole market went up? A positive alpha is a great sign. A negative one? Well, it might make you wonder.
So these ideas, return, risk, Sharpe ratio, alpha, they're not just for finance textbooks. They are real, practical tools you can use. You just have to know where to look.
And here's the secret. All of this juicy information is hiding in plain sight.
It's right there in your fund's official documents, like the monthly fact sheet or what's called the scheme information document. This is your fund's official report card, and now you know exactly how to read it.
So the next time you open one of those documents, here's your checklist. First, how did the fund do compared to its benchmark? Then, what is it actually invested in? What's its riskometer rating? And then look for those pro metrics. What's the Sharpe ratio? What's the alpha? That's how you get the full picture.
So now you've got the tools. The next time you look at your portfolio, don't just stop at that top-line return number. Dig a little deeper, because when you start to understand risk and performance together, you can finally hear the real story your investment is telling you, and that will empower you to make smarter, more confident decisions for your future.